Okay, good morning and welcome back everyone to our options education Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And today we're here to talk a little bit about where the markets currently stand with respect to the recent breakout and the subsequent retest of a major support level. And I think today is a pretty pivotal moment in terms of trying to decide the directional view of the market going into the election. The market's about to test a major support level, and it's going to provide us with quite a bit of insights as to the directional view of the market. So let's go ahead and get started. Before I do, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we'll start off with our general market update, where the major indices currently sit and what the directional view that we have based on that is. We'll take a look at everything from volatility. We've seen some move in terms of rates from the longer duration rates. So we'll take a look at where that's headed. We'll take a look at what impact that has on things like commodities like gold. And then I have quite a bit to share with you on the economics and election front. We've seen a pretty mixed picture on economics, but we've seen some pretty strong numbers come out over the past week or so. So we want to share with you some of those retail sales numbers, highlight specifically with those retail sales numbers where certain sectors have seen some strength, where we've seen some weakness, and then show you some of the ideas that we have for today. So let's go ahead and get started. But the primary question that I want to help investors answer is really, has the market rally that we've seen over the past couple of weeks, has that started to fizzle out? Because we're back to the breakout levels, and it's important to take a look at how markets are reacting. So my name is Tony Zhang. I'm the chief strategist here at Options Play, and today what I'll be sharing with you are my charts, the economic research, and the trade ideas that I currently have with the broader markets. So let's go ahead and get started. Now, if we look at the Qs, this is really where we, after contending with this 282 level for multiple weeks, managed to break out above that level. And now, after just a quick move to the upside, we're now back to retest 282 as support. Now, pre-market and after the close yesterday, the markets did bounce off this 282 level. Right now, it's currently trading a little bit above that 282 level. So it's important to see how markets react to this, because this is a major support level for, if markets want to continue to resume its bullish trend, it has to hold the support level. If we start to break down below this level, we're likely to potentially retest 270 and potentially 260 to the downside as a potential opportunity to go long again. But a fair amount of downside here if we do get that pullback or break below 282. Now, we see this same type of support level on both QQQ, the NASDAQ 100 index, as well as SPY, the S&P 500 index. Just that for the S&P 500, that level is 343, that breakout level. On that breakout, we've come all the way back to retest this level now as support. And the question is whether the markets are going to bounce off that level or break below this level. I think we're going to have our answer here probably in the next couple of trading days. If we manage to hold this level, then we would probably look to reclaim this all-time high here around this 357 level or so, look for a breakout back to that 357 and potentially even higher. As far as what can propel this market to new all-time highs is likely going to need some kind of stimulus, or at least a perception of what would be a sizable stimulus bill. So likely things like the election outcome are the types of events that can potentially provide that catalyst for that to happen. So that's what we're currently looking at. And we see this across the board. It's not just in the major market cap indices, and it's not just the NASDAQ, the S&P. We're also seeing it on small caps. We've been talking about this 160 breakout here on small caps for last week. And recently breaking out above that level, coming back to retest this 160 as support again. And again, if small caps can hold this 160 level as well, that certainly puts the market in a very, in my opinion, bullish tone here. If the S&P, the NASDAQ, and small caps, IWM, can hold these major support levels here. So again, very pivotal moment for the major indices over the next trading days as they test these major support levels. If they can hold them, we think that we can see new all-time highs, or at least retest of the recent all-time highs, and potentially with the election be the catalyst that it could need to break out even higher and resume a longer-term bullish trend and put in, a decent shape to the shape of this recovery. So we see this across the board. Now, when we look at RSP, which is the equal weight S&P 500 index, it is not as strong, but it is also same thing, back to major support levels, the breakout levels around 111 or so, 112 or so. You've had that recent breakout coming back to retest this as support. We want to see these support levels hold here for RSP the same way we want to see it for the other major indices. So this is one that we are paying attention to and is likely going to drive the direction of the larger macro outlook that we have on this market going into the election and post the election. Now, when we look at GLD still remains below this key 180 level here. It has not managed to break back above this 180 level. Momentum is starting to slow down a little, looking a little bit more negative, but it hasn't moved any lower. And you kind of have this triangle here that's forming a little bit here to the upside. And this is what we're looking for, is a potential break to the upside here along with the major indices. So this, from my perspective, gold is kind of sitting on the sidelines and potentially waiting for a catalyst event. The type of catalyst event that I think that could move gold is really stimulus. Stimulus is really the one thing that could spark some inflation, or at least expectations of inflation, and that is likely going to move gold here to the upside if we do get an uptick in terms of inflation expectations. We've already seen a move in rates over the past couple of weeks, so I expect gold to also respond to that, especially if we have a sizable stimulus bill, which is looking less and less likely, especially before the election. But depending on the outcome of the election, that could change fairly sizably in terms of, or the size of the stimulus will likely change depending on the outcome of the election. So that is one that we will keep you updated on as far as what the current trends currently look like with respect to the election. Now, when we look at volatility, volatility still remains very, very elevated. This is due to the, in my opinion, uncertainty around the election. It is still not very clear from polls as to what the outcome of this election is going to be. And there's a lot of angst, if you will, from investors, because I think that there's a lot of concern right now about a peaceful transfer of power. Whether or not there will be a contested election is one thing that is on many investors' minds, and they have bid up both the cost of calls as well as the cost of puts going into the election, looking to buy some protection, looking to buy some hedges on both the upside and to the downside for this election. But volatility remains very high. This, generally speaking, still remains a better environment to be selling volatility, but a lot of investors are concerned about the outcome of the election. So we do see this elevated premium, and this is really where you have to find a balance depending on where you're selling volatility. What sectors are you selling in? It's important to understand that certain sectors are more exposed to the outcome of the election versus others. So you generally want to, if you're going to be selling volatility, avoid the ones that are really exposed, the ones that have the largest, I would say, gaps between the two sides of the government, between being positive or negative, and using that to your, and thinking through that process when you're thinking about selling volatility going into the election. There are certain industries that are just a little less, that will likely react a little less to the outcomes of the election. And those are the ones that, if you're going to be selling volatility, you might want to focus on. Now, when we look at this very important indicator, which is the VIX 3M, the 3-month VIX, compared to the VIX, the front month VIX, what you see is that this ratio currently is hovering just above 1. Generally speaking, we use this as a contrarian indicator. When it's close to 1, this is generally speaking an opportunity to seek long positions, which does coincide well with the current support levels that we are at. But there's one caveat here. If this breaks below 1, that would be a good indicator to start hedging your portfolio, start buying protection. So we are, again, with both volatility and the major indices from a directional perspective at a very pivotal moment. From my perspective, I do think that it's more likely that we see a bounce here, that this is an opportunity to buy the dips that we're seeing currently in the markets. But again, pay close attention to this, because if we do see markets break below those support levels, potentially see this volatility index break below 1, that would put us in a much more bearish tone here for the broader market. So we'll likely see an answer to that question here this week. When we look at HYG, we're starting to see some outflows from these riskier corporate bonds. So if we look at the fixed income spectrum, everything from high yield to investment grade to corporates to long-term to short-term duration treasury bonds, we know that high yield is one of the best performing groups within the fixed income sector. Now, when we look at government bonds, it's one of the worst performing sectors within the fixed income space. So we've started to see a fairly substantial outflow here out of HYG. We talked about the breakdown below 84 here a couple of weeks ago, but it quickly reversed that move lower, but it could not get back above this 85.5 triple top level. So the fact that it got rejected at that level, coming back to retest this 84, the question is whether 84 will hold as support again, or we're going to see a break below 84. So we're really seeing a bit of a pivotal moment here, not only for equities, but also for fixed income. So this is really important to pay attention to as to how markets react to these specific levels. We're seeing this on high yield. This speaks to a bit of flight to safety. Perhaps going into the election, investors do not want to remain invested in some of the riskier assets, and they are looking towards treasury bonds. But when we look at treasury bonds, we're seeing the same type of outflows. So we're seeing, generally speaking, outflows out of fixed income altogether. And this speaks to the rise in interest rates that we're starting to see. The rise in interest rates and 10-year yields is starting to push that 80 basis point level now. And if you look at TLT, this is the 20-year or long duration bond ETF for government treasuries. It's been in a pretty clear downtrend here since the mid of August, if you will. While high yield was performing on par, was moving mostly sideways, TLT corporate bonds has been trending lower. And it has been trending lower to this 200-day moving average. This is the 200-day moving average. Notice how it's bounced off of this level twice already. But the subsequent bounce was very short-lived before it came back to retest this level as support. So could this be the potential break down below the 200-day moving average? Because there is a lot of room to the downside, down to the 200-week moving average. So TLT performing very well here over the past couple of years, and could potentially see a fairly sizable retraction here. So this is, again, another pivotal moment to pay attention to here on both fixed income as well as for equities. Now, when we look at the economic recovery, this is really where there are certain aspects of the economy that look very much like a V-shaped recovery. Last week, we had very strong retail sales numbers come out. The survey was 0.3% growth in terms of retail sales. Actual number that came out, fairly sizable beat, surprise to the upside at 1.4%. This was one of the largest jumps we've ever seen on retail sales in history. So going back to 1993, this speaks to the shape of the recovery from consumer spending perspective, from a retail sales perspective, has been extremely strong. So despite the fact that there are a large number of Americans that are still unemployed, that are on unemployment, it does not seem to have impacted retail sales as much. And this is a surprise for, I think, a lot of investors, is to see so much strength out of retail sales, despite the fact of the economic and fundamental backdrop that we're currently seeing. And if we look at those retail sales, we see that not only is the strength from online, which we know online spending has been very strong. Notice how it's been at decade highs despite the coronavirus. We have never seen these numbers this high over the past decade. And we expect this because, as you can see, every single year it accelerates into the end of the year because of the holidays. We expect the same thing here to happen in 2020. Now, the question is the speed at which we see that acceleration towards the end of the year. Now, Amazon Prime Day in October is certainly going to put a boost here for October. The question is whether November and December will remain as strong. Chances are they will, but maybe a little bit lower because of perhaps unemployment running out, because of the stimulus perhaps not coming out until 2021, the next stimulus bill not coming out until 2021. So this is one we do expect a little softer going into November and December, but we do expect October to be a very strong day as Amazon Prime was moved, or Prime Day was moved from July to October. But if we look at retail sales for department stores, so, like we said, retail sales from an online perspective, we know will be strong. But department stores also very strong. We saw, the shape of the recovery for the department store start to look a little softer here over the past couple of weeks, but a pretty strong bounce here last month. This speaks to some of the names like Nordstrom, Macy's, these types of names, likely finding a little bit of support here going into the end of the year, especially as retail sales continues to surprise here to the upside, despite the fact that online sales has been driving a lot of the retail sales that we've seen. The fact that we're seeing some strength from department stores, from brick and mortar stores, is also encouraging to the shape of the current recovery that we're in. And to give you a sense for the uptick that we're currently seeing in COVID-19, which a lot of investors are pointing to as a potential lockdown or going back into lockdown, as we're seeing a rising number of cases like Europe is seeing. Europe is going into certain forms of lockdown, and depending on different different countries. The question is whether we're going to return to something like that here in the US. However, if you look at the uptick in terms of COVID-19, notice how almost all of that uptick is coming from more rural areas. So the large cities have not really seen an uptick in terms of COVID-19 cases. So this is what leads us to believe that it's less likely to see any type of shutdown or quick reversal to the shape of the recovery because of the rising number of COVID cases. These shutdowns typically will happen in larger cities. We're not seeing that same type of uptick in these larger cities, and that is why we believe that the shape of the recovery can remain in the current state. It doesn't have to necessarily reverse lower because of the rising number of COVID cases, even though some investors have started to position for that. We're starting to see some lockdown stocks become a little bit more interesting, or we're seeing some strength from lockdown stocks. But again, we don't believe that that's going to last because of the breakdown of the cases and where they're actually coming from. And if we look at the picture, the economic picture, industrial production was actually one of the stronger indicators to bounce back fairly quickly and remain fairly strong, but we're starting to see that slip again. So this is really the mixed picture that we're seeing. Consumer spending and retail remain fairly strong. Manufacturing is starting to look a little soft. Industrial production is starting to look a little soft. And this speaks to perhaps more of this kind of, I think, W-shaped recovery that, if we had to pick a letter, either an L-shaped recovery or potentially a W-shaped recovery, depending on which one you're looking for. It's what we're starting to see form as far as the shape of the economic recovery. As we get more and more months of data, this is the type of shape that we're starting to emerge from everything outside of retail sales. Retail sales remaining one of the strongest and probably the primary driver for how equity markets can continue to rally despite the economic and fundamental backdrop that we're currently in. And the fact that we're entering an earnings season is another reason that we're seeing some optimism, some strength from the markets. The banks provided a fairly mixed picture Certain banks did extremely well, JP Morgan, Goldman Sachs, Morgan Stanley. And then you had Bank of America, Citigroup, Wells Fargo, not so much. So a fairly mixed picture. And this week is also another big week for earnings. So pay attention to earnings and see how that's going to affect the outlook of the market, the optimism of the market over the next few days and next couple of weeks. So just to take a look at the election and some of these statistics, not a whole lot has changed over the past week here. The expectations of Biden winning the election is still hovering around these levels here. In terms of Democrat versus Republican, in terms of Biden versus Trump, these numbers haven't moved very much, 51% to 42%. It's actually moved a little bit better in Trump's favor here over the past week, but very, very small movement here in my opinion. So not of significant move in terms of Biden versus Trump. The one thing that we have seen some movement here is the declining view of a Democratic sweep. Only a 57% chance of a Democratic sweep versus the increase in terms of Republican sweep has increased from 5% to 11%. 11%, still not a very high number, but a fairly sizable change here over the past week or so in terms of what Congress and the Senate is likely going to look like. So Democratic sweep still by far the most probable, and you have now a 15% chance of a Democratic House with a Republican Senate. So if Biden was to win with a Democratic House and a Republican Senate, that is the outcome that is probably the least favorable from the market's perspective, because you have this Democratic president that wants to put forth perhaps a larger stimulus bill and a federal task force for the coronavirus, while you have a split Congress or a split Congress that is likely going to impede some of that to some degree. So that is likely what's going to cause some uncertainty around what markets are going to react, and that is likely what's going to drive some underperformance of the broader markets. And like I said, the one thing that's likely going to cause the most amount of underperformance is really more of a contested election. If we have to go to the courts to declare a winner for the president, that is what's going to cause, I think, during that time of that contested election, and while it's in the courts, that is when the markets are likely going to sell off during that time. So that's how we're currently looking at the markets going into the election. We still have a few weeks left to go, or a couple of weeks left to go. So very, very important to pay attention to some of these changes that we're starting to see. Now, when we look at some opportunities here in this market, we really have to turn to some of the technology names. And, for those of you that follow me on CNBC, I brought up a Snapchat trade last week. Pinterest falls into a very similar category as the Snapchat trade. If you miss that, Pinterest is one that I also still think has a lot of strength here, potentially for more upside. We see the same type of strong download data from Pinterest as we do see from Snapchat. Pinterest, a smaller platform, but also doing fairly well in terms of engaging their viewers, the same way Snapchat is doing fairly well compared to platforms like Facebook, Instagram. And what we like to see here with a name like Pinterest is the continuation higher here and a recent breakout above this $44 resistance level, breakout higher. We have momentum and money flow or accumulation distribution confirming these new highs. This is potential, from my perspective, an opportunity to look for a long position in a social media name here like Pinterest. On the downside, we're starting to see momentum really slow down here for some of the sectors, specifically XLB materials, one of the strongest sectors that we've seen in the broader markets, have really struggled to break to new all-time highs. And we're starting to see what looks like a bit of a double topping formation here and potentially a pullback here into the $64, $62 level here. As you can see, accumulation distribution looking fairly weak as these markets started to trade a little sideways, trending a little higher, accumulation distribution actually moving lower in response to that, and you see momentum no longer confirming any new highs. So this is potentially a top here that we're starting to see here form in some of the sectors. And maybe this is just a bit of rotation out of materials into some of the more defensive sectors. We've seen utilities really take off here over the past couple of weeks. So we're seeing a bit of rotation here starting from some of the stronger sectors into some of the weaker sectors. So pay attention to that coming up over the next couple of weeks. When we look at a name like Tyson, which is in the protein farming industry, competing, and this industry has had some issues. It's had some lawsuits recently with regards to price fixing in the chicken market. So Tyson is really one of the stocks that I'm seeing under a bit of pressure here, and it's about to test, or is testing, some major support levels in this $56, $57 level here. And what I'm looking for is a potential breakdown here below these levels, and I see a fair amount of downside here on this break. As you can see on the accumulation distribution, it's already broken those support levels, and that is the confirmation that I'm looking for a potential move to the downside here. So looking at Tyson, momentum looking fairly weak, relative strength looking very weak, and if you look at the market breadth, looks like it's already started to break down to the downside, seeing a lot of distribution for this particular stock. So this is one that I'm looking for some downside in. And lastly, ADP. This is really one of the employment names that we've been following for quite some time. And this is a stock that predominantly has been trading into this triangle that we're starting to see. And we've had a recent strong rally here. Most of this, I would say, is off of the back of optimism for stimulus, optimism that employment is going to see some gains here as a result. This ADP processes a fairly sizable chunk of America's payrolls, and ADP processes benefits, payrolls for employers. Many small businesses rely on ADP, so there was a lot of interest from investors to look at ADP as a proxy for the probability of the stimulus. We've seen those stimulus, I would say, hopes fade here a little bit over the past couple of days, and I think this is an opportunity to fade some of the strength here in a name like ADP that's gone just a little too far too fast and is likely going to come back down to earth. As you can see, the last time it responded to the 200-day moving average, had a fairly sizable move to the downside. We're seeing the same thing here, an acceleration to the 200-day moving average, rejected at that moving average, and is likely going to recede back into that low 130s level here for ADP, especially as we start to see, especially today, if we find out that we don't see a stimulus, a verbal of a stimulus today, we're less likely going to see this before the election, and what's less likely to see it by the end of the year. So ADP starting to see some of those hopes fade, and a proxy for some of those hopes and potentially want to fade here. So with that, that covers what I wanted to share with you here today. Like I said, we're at some pretty pivotal moments here in the broader markets. Pay attention to them because they're going to be very helpful in giving you a better understanding as to the directional view of the markets going into the election. With that, thank you so much. I'll be back here next week before the election to again update you on how everything is going, and we will make sure that you have a better understanding going into the election. So with that, thank you so much. Have a great day, and I'll see you guys next week.